Hello, this is Tulane University's Burkenroad report video for Stone Energy. My name is Jimmy Dunn, and along with my fellow analysts, Frank Darden, Mitchell Karam, Andrew Karst, and Tyler Harden, we would like to thank you for watching our analyst report. Stone Energy is a publicly traded company on the New York Stock Exchange, traded under the symbol SGY. The company is an independent, Lafayette, Louisiana-based energy company that has additional offices in New Orleans, Louisiana, Houston, Texas, and Morgantown, West Virginia. Stone Energy specializes in the acquisition, exploration, exploitation, and development of oil and natural gas properties. The company operates offshore in the Gulf of Mexico. Stone Energy also has operations in Appalachia's Marcellus Shale and in Louisiana. Stone Energy's stock price as of March 13, 2013 was $22.16. The past 12 months have seen Stone Energy's stock at a low price of $17.43 and a high price of $32.64. Stone Energy's market capitalization of $1.1 billion placed the company in the same peer group as offshore exploration and production companies, including W&T Offshore, Energy 21, and EPL Oil and Gas, and onshore exploration and production companies like Exco Resources and Carrizo Oil and Gas. The company is continuing its strategic plan that seeks to mitigate risk by diversifying its asset base and grow in deep water and the Appalachian region. By producing in Appalachia, the company hopes to earn adequate cash flow for future projects and its deepwater properties. Additionally, deepwater acquisitions demonstrate the company's growing presence and commitment in the Gulf region. The acquisitions, highlighted by Stone Energy's 2012 purchase of the remaining 25% interest of the Pompano Field from Anadarko Corporation, position the company as a major player in the Mississippi Canyon region of the Gulf of Mexico. Based on provided company guidance, Stone Energy is projected to produce between 40,000 and 43,000 barrels of oil equivalent per day in 2013. Stone Energy reports its production on SEC filings as gas, natural gas liquids, and oil. In the coming years, Stone Energy wants to increase their focus in deepwater prospects and plays. With their acquisitions of the Pompano Field from BP and their continued operating and non-operating acquisitions in the area, Stone Energy is poised to become a dominant player in the Mississippi Canyon region. Stone Energy wants to continue their steady operational levels in the Appalachian region. The Appalachia regions remain a viable option for continued low-risk cash flows. Stone Energy is slowly moving away from the conventional shelf to invest in riskier deepwater plays. Stone Energy wants to maintain stable shelf oil production in the near term while slowly phasing out some of their production in order to reallocate capex in the coming years. Stone Energy's strategy consists of drilling 2 to 4 offshore gas wells per year for the next 3 years. In 2012, the company further developed its operations to handle the increase in liquid-rich gas production. The company's discoveries at La Cantera and South Erath off the southern coast of Louisiana, combined with its working interest in 2 new prospects in La Montana and Tigre Lagoon, position Stone Energy to profitably grow liquid-rich gas production through exploration. Our investment thesis is focused on 3 main factors. The first factor is Stone Energy's diversified resource base, which mitigates operational and macroeconomic risk. The second factor is Stone Energy's capital expenditure reallocation away from conventional shelf and to deepwater reserves. And finally, the third factor is the promising outlook for Stone Energy's deepwater prospects. Stone Energy's diversified asset base not only provides for a balance of operational revenues, but also mitigates overall commodity risk to the company. Stone Energy has been actively shifting capex away from maturing reserves in the conventional shelf to higher growth deepwater properties. This shift in capital allocation is further bolstered by the company's Appalachian operations, which provide stable cash flow for the more expensive deepwater projects. Guidance for Stone Energy's 2013 capital expenditure allocation is shown in this figure. We believe Stone Energy's deepwater prospects show considerable reserve growth and production potential. Although deepwater production is more expensive than conventional shelf production, the potential reserve size can more than make up for production costs. The company's development of its Pompano platform is instrumental to Stone's growth in the deepwater. Stone Energy is also taking advantage of Louisiana light sweet crude pricing, which tracks Brent crude as opposed to WTI. In order to determine the appropriate target price for Stone Energy, we considered multiple valuation methods. Our team felt that the two most appropriate methods for Stone Energy would be a PV10 and an enterprise value to barrels of oil equivalent of proved reserves multiple valuation based on the average of a comparable peer group. Based on our valuation methods, our projected share price of $34 for Stone Energy places them in the market outperformed category for the next 12 months. The PV10 method is a common industry method used to value exploration and production companies. The method discounts the projected cash flows associated with producing existing reserves, less the expenses associated with production of these reserves, denoted by lease operating expenses, at a discount rate of 10%. This valuation method is a standard in the industry as it bases the valuation of a company on the proven reserves the company has and that the company's ability to produce those reserves over time. To calculate cash flows from production, a production model was created for Stone Energy using proven reserve data provided by the company along with production assumptions based on industry standards and historical realized production rates for Stone. The pricing deck used was developed using EIA forecast data, then adjusting for Stone Energy's existing hedges and the price differential realized for oil produced in the Gulf of Mexico that is sold at Louisiana light sweet prices. The PV10 valuation model produced an estimated total value of slightly over $1.8 billion, or $36.80 per share. The second method used was an enterprise value to barrels of oil equivalent of proved reserves multiple based upon the average multiple of Stone Energy's peer group. This method was chosen as it provides a valuation based upon the company's proven reserves, which removes variation that can occur between companies related to management's decision around operating expenses and CapEx. To determine the proper enterprise value to barrels of oil equivalent proved reserves for Stone Energy, we use the average of a peer group. The peer group was determined by selecting companies of similar size and market cap with similar areas of operation as Stone Energy. The average enterprise value to barrels of oil equivalent proved reserves of Stone Energy's peer group was 16.96 times. Using this multiple, we calculated an enterprise value for Stone Energy of approximately $2.2 billion, resulting in a per share price of $32.15. In conclusion, thank you for your time. We hope you enjoy learning about Stone Energy. We look forward to seeing how Stone Energy expands into the deep water. The Burkenroad reports are produced solely as a part of an educational program of Tulane University's A.B. Freeman School of Business. The reports are not investment advice, and you should not and may not rely on them in making any investment decision. You should consult an investment professional and/or conduct your own primary research regarding any potential investment.